Welcome. In this video, I will show you how to create a growth model for stock analysis using Excel, based on Phil Town's rule number 1 strategy. By the end of this tutorial, you'll be able to calculate a stock's fair value in using EPS growth model. Step 1. Setting up your spreadsheet. Open a blank Excel sheet, and we'll start entering data in cell A1. In this cell, enter the title, Earnings Per Share Growth Model, to set the context for the sheet. Step 2. In cell A2, enter the label, EPS, TTM. This stands for earnings per share for the trailing 12 months. In cell B2, input the EPS value from the latest financial report of the company you are analyzing. For example, let's use Nike's EPS from my last stock analysis video, which is $3.73. Step 3. Next, in A3, label it, growth rate, and in B3, input the expected EPS growth rate. For this example, we'll use 7%. Step 4. Now, in A4, label this as estimated PE ratio, and in B4, input the estimated price to earnings ratio for the future. We'll use a PE of 27 for this example. Step 5. In A5, label this section as years, representing the projection period. In B5, enter 10 years for a 10-year projection. Step 6. In A6, label this as return on investment. The ROI measures how much you expect your investment to grow annually over a given period. Essentially, it tells you the compound annual return you would achieve if you bought the stock today and sold it at the future stock price. In B7 we will add 8%. Step 7. Next, we'll calculate the future stock price. In A7, label this as future stock price. In B7, input the formula equals earnings per share for the trailing 12 months times by the estimated PE ratio times, then open brackets, 1 plus estimated growth rate, close brackets, then raised by the power of the years. This formula uses the current EPS for the trailing 12 months, multiplies it by the estimated PE ratio, and factors in the growth rate over the specified number of years. Step 8. In A8, label this as sticker price. Use the formula equals future stock price divide by open brackets 1 plus the return rate close brackets raised by the power of the years. This is to discount the future stock price back to the present value, using a desired rate of return, typically 15%, but for this example we are using 8%. Step 9. In A9, label this section margin of safety 25%. To calculate this, multiply the sticker price by 0.75 to apply a 25% margin of safety. If you would prefer to save yourself the time of making the spreadsheet, click on the link in my channel description to purchase it. If you have found this video helpful, please give it a like and consider subscribing.